Hey everybody, back with another dividend analysis, and today we're going to be looking at Broadcom Inc., or AVGO. We're going to be looking at Broadcom because I keep getting requests for it and I want to get it out of the way. So without further ado, let's start with the dividend yield, and as we can see, we're right below 3%, which is pretty decent for a company in general, and for a tech company, 3%'s pretty good. Usually you're going to be below 1% for a lot of tech companies, so that's pretty nice. Going back through the history, let's take a peek. And we can see that we're currently getting about $3.60 a share, and going back to 2010 we were looking at 7 cents a share, so a lot of growth. As we can see, back 2011, 2012, 2013, they were actually raising the dividend every quarter. I'm going to assume that there was probably a cut before this due to the financial crisis. I haven't seen that information, but you can look that up yourself to see, so just be aware of that. That might exist. But going back 11 years roughly, we've got growth every quarter up until about 2016, where we started to go with yearly increases. But as we can see, we went from 7 cents up to $3.60, so hundreds of percent. Very nice there. And even the last yield increase was about 10% from 325 to 360, about 10% there. Before that, about 20%, give or take. So the dividend has still been increasing steadily and heavily over the last couple of years, so that's good to see. Let's go look at the numbers and see what they tell us. We can see that last year they paid out $5.6 billion in dividends, and let's start by looking at the cash flow. The trailing 4 quarters, we can see that their cash flow has been increasing pretty much every year for the past, 9 years? 9 years or 10 4-quarter periods, back from under $1 billion to almost $13 billion. That is very nice to see. A lot of growth, very steady growth. There are a few huge jumps in there, so you might want to go see how those huge jumps are occurring, but a lot of growth is nice to see. Next, we can check out our free cash flow ratio for our dividends, and dividing that $5.6 billion into our almost $13 billion gives us a 44% payout ratio of free cash flow, which is very nice. Under our ideal range of 50%. What does that mean? Even if their free cash flow here was to drop in half, they would still have the free cash flow to cover that dividend. Not by a lot, but they would still have it. And of course, a 50% drop in free cash flow is an extreme. So if their free cash flow were to drop in the next year or two, they would still have plenty of room. That also means that they have a lot of room to increase the dividend in that free cash flow. Next, let's go take a peek at income. For this one, we're going to go again by the 4 quarters, and let's see what we have here. Net income last year was $4.88 billion. That should spark some red flags for any of you watching, because that is less than how much they paid in dividends. $5.6 billion divided by $4.8 billion leaves us with a payout ratio of 114%. What does that mean? That means that they are paying out more in dividends than they are bringing in income. That is a concern, but let's see if there's a reason for that. We can see that they, about 4 years ago, they made $11 billion in free cash flow, whereas that then dropped to $3 billion, $2.5 billion, and is now back up to almost $5 billion. I'm willing to bet that such a large business with such a diversified portfolio bought some things, then wrote them off because they weren't worth as much as they thought they were. There is some financial gymnastics going on there, I bet. Now, like some other stocks we've seen, we don't want to see our income be less than our dividends paid out. However, we do have some positive news in that it increased over the last 12 months from the 12 months prior. We went from $2.5 billion, that almost doubled. That's very good to see. If that continues to go on, if we see this 4.8 turn into over $5 billion for the next 12 months, and then maybe over 6 for the 12 months after that, that's gonna be very reassuring. That dividend isn't going to be in much trouble. However, if that number decreases or over the next 2-3 years and stays below the dividends paid out for an extended period of time, that will start to raise flags with regulators and other things. So just keep an eye on that income, see that it keeps going out so they're able to cover that dividend. What might happen is those dividends might start to slow down in increases, as we saw it went from about a 20% increase 2 years ago to a 10% increase last year. So that dividend appreciation might start to slow down depending on what this income does. Just keep an eye on that. So where are they getting all of this income or all of the income that they had that they aren't as much now, and this free cash flow from. Broadcom is an extremely diversified tech company. They do semiconductors, they do software, they do a bunch of everything. It's very hard to see where their income's going to be because they sell so many different things to so many different sectors. So trying to gauge how their income and their cash flow is going to come out is going to be a little difficult. You're going to have to do a lot of investigation into what percentages of their revenue and their profit comes from what sector of their business. So just know you're going to have to do a lot of research into this if you want to keep up with that. Should you be buying Broadcom? Is this a good dividend play? Is this a good income play? This one's a little tricky. There's a lot of things about it that make it difficult to really assess. The income being one. However, if that starts to trend upward, then that's really not an issue. One thing that I do like to point out is that the stock price per share price is very prohibitive for most investors, nearly $500. I know most people who watch this channel don't have hundreds of thousands or millions of dollars lying around. A $500 investment was probably a lot of people's weekly or monthly investment. And that can be an issue. If you've only got, say, $500 a month to invest, you can only afford one share of Broadcom a month, which means you're not going to be diversified. That could be an issue for you. Of course, if you have tens, hundreds of thousands, millions of dollars, that's not an issue, but you're probably not watching this because you know what you're doing. So what do you do here? If you're looking for a tech stock with a dividend, there are other choices that are much cheaper share prices and are going to be easier for you to invest in on a regular basis. For example, IBM is $140, STX is around $80 or $90, and there are some even below that. So don't think that you have to get Broadcom, and seeing this prohibitive share price, you're going to be missing out on a lot. From the dividend perspective, not really. I can't say anything from the growth value perspective. I don't know. I haven't done that much research on that. On this company that way, but from the dividend perspective, you don't have to worry about FOMO on this for dividends. There are other choices. You're going to be okay. One thing you could do is look for dividend ETFs that hold Broadcom if you really want to be holding this. There are a bunch. I know SCHD holds it, and there are a bunch of other ones that are going to hold it. So that might be a way. If you don't have a ton of money to put in at a time, you don't have $500 a week or a month to dollar cost average in, getting it through an ETF that holds it would be pretty good. From the dividend appreciation perspective, as we saw, it's been doing very well. I mean, you're going from 2010 to 2021 and hundreds of percent of increases. Even just the last increase was 10%. There's a lot there. From the income perspective, 3% for a tech dividend is pretty good if you have an income portfolio and you need to allocate some money to technology. This wouldn't be terrible. Again, there are other choices like IBM that pay more and are cheaper. But, this isn't terrible. This could fill a spot in an income portfolio on the lower end of your yield vehicles. It's kind of a complicated stock. There's a lot of different things to look at, but it's not terrible. I do a lot of research into how they're getting their money, what the future holds before I would tackle this. That's about it, and I hope it helps, and thanks for watching.